Hello, my name's Chris Parkman and today I'm discussing directors' employee claims and whether or not a director can make a claim from the Redundancy Payment Service if they place their company into a formal insolvency procedure, for example, Creditors Voluntary Liquidation. Historically, the Redundancy Payment Service have always been reluctant to pay out directors' claims for two main reasons. Firstly, it was their view that directors were either directors or employees, but not both. Also, because directors are typically the party who signed the paperwork initiating the insolvency process, they had therefore effectively voluntarily made themselves redundant and therefore forgoed any claim. Thankfully, it is now well-established case law that directors can be both directors and employees, and therefore, if directors do place their company into Creditors Voluntary Liquidation, for example, and are employees, then they're entitled to claim from the Redundancy Payment Service. The key issue, therefore, is establishing whether or not a director is an employee. So how do we do that? For me, the starting point is always the payroll file. If the director is paid monthly through the payroll, just like any other employee, has monthly wage slips, it's clear evidence that they're an employee of the company. The Redundancy Payment Service will ask and want to see any written forms of contract of employment if there are any. Contracts of employment can sometimes be verbal, and therefore if there is no written contract of employment, in my view that's not necessarily the end of the world. Is there any other documentation? For example, board minutes setting out the terms of the director's employment, salary to be paid, etc., etc. If there are, then that may well be sufficient. Now, assuming that we can establish the director is an employee, what can they claim for? Right, first point is redundancy. Redundancy can be claimed by any employee, including a director, if they've got a minimum of 2 years service. Basically calculated between half a week to a week and a half per complete year of service, depending on the director's age. Then there's notice pay. Notice pay is essentially a week per complete year of service, and there's also arrears of wages and holiday pay. Now you may be thinking, my accountants advised me to take the minimum amount to keep up to date with my national insurance contributions and take the rest of my remuneration through dividends and drawings. If that is the case, then you might be thinking, well, my employee claim is going to be very small, it's not worth bothering about. However, if you are an employee and the Redundancy Payment Service are going to process and pay out your employee claim, they must pay out in line with the national minimum wage regulations. What that means is, if you work 35 to 40 hours a week, for example, your weekly wage will actually be more in the region of, say, £350 a week, and if you've got a substantial number of years service, it can quickly mount up to quite a substantial claim, and therefore it is always worth considering. There is one other final issue that needs to be taken into account, and that is your director's loan account. A director's loan account is basically a summary of all the ins and outs between a director and a limited company. For example, if a director buys something using their own personal funds, the company then owes them that money back, which is called a credit. Similarly, if the director takes drawings on a monthly basis and then clears the balance at the end of the year through a dividend, those drawings are debits. So at the end of the life of the company, when it's placed into insolvent liquidation, if the net balance on that loan account is that the director owes money to the company, then the Redundancy Payments Service will first offset any employee claim against that overdrawn balance. For example, let's assume the director has an employee claim for £8,000, but he owes the company £5,000 on his director's loan account, i.e. he's got an overdrawn balance. What the redundancy payments will do is they'll offset that £5,000 against the 8 and then pay a net 3 out to the director. Now, at the end of the day, it all amounts to much the same thing, because the director would have needed to repay that £5,000 back to the company because it's an outstanding debt, just like any other. So it's always still worth doing, and at the very least, if you do have an employee claim, it will reduce any overdrawn balance if, for example, the overdrawn balance is more than the employee claim. Directors can claim redundancy and all the other claims from the redundancy payment service when they place their company into a formal insolvency process, and it's always a good idea to take formal advice on that and work out in advance what the balance on the director's loan account is and what's the level of the director's employee claim. If you would like a free meeting to talk through it and work out these figures to see what you could claim if you were going to place your company into Creditors Voluntary Liquidation, please give us a call to arrange a free telephone meeting. Thank you.